They certainly set cat amongst the pigeon on Friday when they gave what is a modern terminology of profit warning. Post numbers, they upgraded the guidance. Now they've brought the guidance back to the lower band. Why? What does this indicate? And are we in for more nasty cuts and downgrades from analysts and from the management going forward? C. Vijayakumar, CEO and Managing Director of HCL Tech, joins us now. Good morning, Vijay. Thank you for joining us. Now, you said that furloughs are higher than anticipated. Could you give us more details on that, and how much are they higher than the average, and which are the segments where the furloughs effect has been felt?
So the macro impact, whatever we had envisioned in the beginning of the quarter, that was in early October, versus what we are seeing now, is a little bit higher. And that is the reason we said we will be at the lower end of our revenue guidance. And if you look at our guidance for services, it was 16 to 17%. And even at 16%, it will be one of the highest growths in the industry. So we continue to do very well across all the key service lines, application, infrastructure, and engineering services. So I don't think you should read too much into this, except that it's a small blip due to slightly higher furloughs and a little bit of reduction in the discretionary spend in some segments like telecom, tech, mainly.
Sure. You've been meeting a lot of clients in the US as well, as we understand. Give us a sense of how client budgets are likely to shape up and whether the deal momentum win is going to, continue to remain intact.
The deal momentum continues to be robust, and we expect decent bookings in this quarter and probably in H2. And the deal activity is quite robust in the market, especially around cost efficiency and vendor consolidation opportunities, which are really our sweet spot. So I think the deal activity gives us a little more confidence about what we have said that we will achieve during the year. But we also said another thing during the Investor Day, that's about our margins. We expect to, in the near term, go to the 19 to 20% band as against the 18 to 19, which is our guidance in this year. That's primarily because the talent situation is easing a little bit. Attrition is coming down. And we've taken a lot of steps in the last year, like increasing freshers, a lot of emphasis on upskilling and training our talent, and also a little more initiatives around nearshore. All these initiatives will start showing up in the margins in a couple of quarters. So we are also aspiring to get back to our 19 to 20% range. So I think these are real positives, and at 16% services growth will continue to be one of the highest growth in the industry. So I want to kind of highlight a few points as I mentioned.
So services at about 16 to 17%, but what about PNP? Because December is historically one of the strongest quarters. Any reason that we're seeing a slowdown here?
We expect it to be good. So far, the momentum is good, but however, the software business, a lot of things happen in the last 2 weeks. So it's a little early to call on the software business.
You've talked about levers available for margin to trend to 19 to 20%. Could you give us some details? How much of those levers, as per ground deal decision making, is delayed? Pricing is a bit difficult as well, what we understand.
See, deals are not getting delayed. I think at least in the US, the decision making and the deal activity is very robust. And in fact, there is a little more urgency towards vendor consolidation and cost efficiency kind of deals in the US. In Europe, maybe it's a little soft, but overall, I see the momentum to be quite strong. Pricing, of course, it depends a lot on the nature of offerings, managed services, or digital transformation. So Of course, we had a good benefit in realization in the last couple of quarters, but I expect the pricing to be stable from here on.
Okay, so glad that you could take time out and speak with us today. Thank you so much for joining in.